Forward Sustainably is a podcast that captures sustainability insights from leaders across diverse industries and sectors. This podcast offers us one way to live out the Wisconsin idea, expanding the benefits of the University of Wisconsin system outside of our walls. Today, we welcome Mitch DeWitt into the studio to talk about sustainability in the financial industry and environmental, social, and governance, or ESG investing. Mitch is a financial advisor at Walkner Condon Financial Advisors. He studied industrial and operations engineering at the University of Michigan, Ann Arbor, and has his master's of business administration from the University of Wisconsin-Madison. One area of expertise includes helping people align their investments with their values. I'm Amanda Getch, Program Manager for the Sustainable Management degree programs at the University of Wisconsin Extended Campus. Let's get started. All right. Hey, Mitch, welcome to the program.
Thanks for having me.
Yeah, thanks for being here today.
Of course.
Let's kick it off and just have you tell us a little bit about yourself.
My name is Mitch DeWitt, and I'm a financial advisor at Walkner Condon Financial Advisors in Madison, Wisconsin here. And I have a particular interest in sustainable investing. So this is something that I've been working on for about 4 years. So pretty much right when I got into the field. I have an engineering background, but life circumstances led me over to the financial planning world. So here I am.
Nice. And that was something I wanted to talk to you about, how you made that pivot. I know you were at the University of Michigan, Ann Arbor, and I'm going to get this correct. You studied industrial and operations engineering.
I did.
Yeah.
Yes. So I studied that. My career path shows that there's very little time that was actually spent in industrial engineering if you actually look at my resume. So I ended up working for a company probably well known in Wisconsin, Rockwell Automation, headquartered out of Milwaukee is their global headquarters. So I started as an intern there and then ended up turning into full-time, made a couple moves within that organization and really enjoyed what I was doing. It was on the kind of controls engineering side of the world, but I was working with different engineering firms, essentially, for a truncated version of my Rockwell story. Ultimately, there was a corporate restructuring and my position was eliminated. So about 4 years at Rockwell, corporate restructuring, job was eliminated. And then I had some time and a severance to figure out the next step.
Nice. And how did you make that next leap into financial advising? It
wasn't overnight. That's for sure. It was not hey, I wake up and next thing you know, I'm at Rockwell and now I want to be a financial planner. That wasn't not it at all. There were a couple of trusted resources and people that I knew that were in my ear. So after they knew what happened, one side was at a company that's also pretty well involved in Wisconsin, Thrivent Financial. I knew a guy there that they said, "Hey, have you ever thought about financial planning?" No, I haven't. Then someone else from BMO Harris Bank said the same thing. No, I haven't. And after a few different coffee discussions and just meeting people and networking, it turned out to be, maybe this is something I can pursue. So I did. And I did an MBA program throughout that transition as well with more of a focus on the finance side. So that helped really accelerate the learning curve to launch into the new career.
That is amazing. I love hearing about those stories where things just kind of line up and you find your passion, you find opportunities, you find the right people. So,
well, and my thought was I truly had benefited from some planning and advice in the time of, oh, hey, your job no longer exists. That was there yesterday. And so I had the emergency fund set up. Granted, I had a severance and things, but I truly felt like I'd benefited from financial advice. So it started to make sense that, hey, this is something I can actually pay forward and hopefully help others as well. And so that's where I am.
And that is a great transition into more of the sustainability focus. So paying that forward. How do you integrate sustainability into what you do in financial advising?
Yeah, so I think most of what we'll talk about probably is going to be on what people's options are when it comes to where they put their money. And sustainable investing is a big part of that. So I think my role in that as a planner, I think people usually come to us typically with, hey, I don't know what to do with these retirement funds, or I've got these different accounts everywhere. I need to make sense of it. Am I going to run out of money? Those are some of the reasons people come to us. But then it's the education of, okay, you have a decision and you have some choice in where your money goes. And a lot of people feel like they don't have a choice. So I think my role is part of education around that, knowing what options are available. And there's a lot of options when it comes to sustainable investing. And we can talk through that probably on this podcast too, as far as defining some of the words that you hear: sustainable, environmental, social, all these different words around it. But education is a big part of what I do.
Why don't we jump in and just go ahead and define some of those? So I know we talk about socially responsible investing, environment, social, and governance, or ESG investing. That's becoming a really hot topic, especially with the really large organizations around the world, publicly traded companies, things like that. So why don't you offer us a few definitions just so we can have a good platform?
Sure. So on one side, socially responsible investing is a term that's been around for decades. I mean, it's not a new term by any stretch. And what I think of socially responsible investing, and traditionally what it has been over those many decades, is, hey, I want to invest, but I don't want to invest in the quote unquote bad things. So traditionally it might be alcohol, tobacco, firearms, right? So I want to invest in pretty much everything, but exclude those three things, let's say. So that's kind of socially responsible, and it's been around for decades. If you fast forward to 2019, people are a little bit more proactively seeking the types of things that they want to invest in. So instead of a negative screening, in other words, getting rid of the bad stuff, we hear of like thematic or sustainable or impact investing, or some of these buzzwords, right? That's more of, hey, impact first. I want to pick some sort of investment or fund or organization that is doing something about carbon emissions, for example, or renewable energy, right? And I'm proactively seeking that and want that in my investment mix as well. So that's the spectrum as it's come over the last several decades. Negative screening versus proactively, hey, let's get some of these criteria that have proven to be outperformers for an organization and linked to their sustainability of an organization.
That's great. It reminds me of parallels in other industries, like the green building industry or the sustainable built environment, where we've gone from a building having a negative impact on the environment or human health, and then we've gone to like carbon neutral, and now more and more buildings, and even mentioned, in these debates recently, people talking about buildings that are only having a positive impact on the environment. So I think we're seeing this values kind of blanket over so many different areas of our lives. So it's very interesting.
Oh, for sure, for sure. And the other thing that you kind of mentioned too is just the ESG. And I'll repeat that for listeners if you've never heard that term, but environmental, social, and governance, or corporate governance is what the G stands for. And that's something too that we're seeing more and more and more funds being incorporated into their investment strategy. So if I say fund, I mean, all right, I'm an investor. I invest in some sort of fund. Maybe it's through a 401k at work, or maybe it's in my own brokerage account, or wherever it is. And there might be hundreds of organizations in that one fund that you support. And by linking these environmental, social, and governance, ESG criteria to that fund, that means that they have a higher bar, I'll say, for the organizations that they select as being part of that fund. And they can get scored on each of those categories. They get scored on the E for the environmental, they get scored on the S, they get scored on the G. And then there's a blended formula, kind of a weighted formula that ultimately gets your ESG or your sustainability score. And there's lots of organizations that are doing that now. But that's an area too that ESG is something that there's a huge trend. Money is flowing into these funds like crazy. I mean, you look at the charts, there's the exponential growth curve, that you see in like the classic clip art example that when you're searching for a growth or whatever.
Flashback to econ.
Exactly. And it looks like that literally, because there are trillions of dollars. I mean, some 2018 sources say there's 11 trillion. I've seen others that are like 24 trillion, but that's trillion with a T. And money is going into these funds, but that's still only like 1 in 4 dollars that are invested are actually going towards ESG funds.
So 2 follow-up questions to that. One, is the data available? Are you seeing an increase in data available on ESG from companies, or is it still difficult to extract that data from companies? So basically, what's their response to consumers' want for that information? And when you were talking about trillion, that sparked in my mind BlackRock.
Mm-hmm.
So could you talk a little bit about BlackRock?
Sure.
And could you talk a little bit about data availability?
Yeah. I'll hit data availability first. Does that work?
Mm-hmm.
All right. So data availability, it's getting better. It's not quite transparent to the average investor, I'll say. And by that, there's data to support this. So USIF, it's a Sustainable Investment Forum. They come out with this annual report every year. And 2018 report, one of the conclusions is that people are interested in this, particularly millennials, particularly women. But I mean, you'd be surprised at the Gen Xers, the baby boomers that are also interested in sustainable investing. They're interested in ESG investing. But it's exactly that, interested in. That does not mean that they are investing with respect to these ESG criteria. So that's a huge thing. And I think part of that is because of the typical investor does not know where to find the information. So they don't know where to find it. They might not even know it's available. And then they don't know what to do with it if it's there. So that's the big gap that I see now is people are clearly interested in this, but they don't know how to go about it. And it doesn't have to be that hard, right? Sometimes it can be as simple as just looking at your investment options. And if you see that there's an ESG link there, that's a step in the right direction. That's probably going to align more so with your values if that's something you're close to. It might not be perfect because there's literally going to be hundreds of organizations that are under, a true diversified portfolio. But I think having the criteria in place is a step in the right direction. So there's many organizations that try to make it more available. So MSCI is an example of an organization that you'll hear of. Sustainalytics, Morningstar. I should have led with Morningstar. Now that I think about it, Morningstar is probably one of the more common ones. Historically, people think of a 5-star fund, and that's a Morningstar rating, and that's solely based on financial data. It's based on past performance, not looking at future guarantee of returns or anything like that. But that was a financial metric. Morningstar, over the last decade, probably has developed a sustainability rating system where instead of 5 stars, they still have that on the financial side. There's 5 globes. So a 5-globe fund is one that ranks very highly in sustainability. It's in the top 10% relative to their peers. So that's one way that you can say, hey, this fund has a 5-globe rating. If that's something important to me, it's probably a step in the right direction. And funds sometimes can change too, from 5 globe to 4 globe, et cetera. But staying on top of that, I think, and knowing that there's Morningstar, MSCI, there's lots of financial advisors, depending on where you're listening, they're all over the place that know how to interpret some of this data. So I'll stop there. That's the first part of your question, I think, but that's on the data availability side. Is there any thoughts you had before the BlackRock side?
Yes, because I know BlackRock is a very exciting conversation to have. With regard to the Morningstar, just a follow-up, they have globes for the sustainability investments or stars for the purely financial. Are those two integrated?
Currently, no.
Okay.
No, so it's 2 separate things that you have to look at because people want performance, right? So that's a whole other maybe tangent to the discussion that I should at least comment on is that in my world, it's people primarily still want returns, right? So there's this whole other spectrum of traditional investing is returns at all costs. I don't care what I'm investing in. That's traditional investing, right? As we morph over to the sustainable side, people still want returns because they still want to retire or do the things that they want to do, save their kids' college, whatever it might be. But they want to have the sustainability metrics built in. They want a social impact, some sort of social or environmental measurable impact that they can trace alongside returns. And then if you go even further on that spectrum towards like impact, I would categorize impact investing as impact first, meaning I'm giving money towards some sort of cause that has social or environmental measurable impact. If I get a return, great, but that's secondary priority to the social or environmental metric. And then even further beyond that is charity, right? Where charity is just, I have zero expectation of return. I'm giving my money. That's philanthropy, right? Mm-hmm. So that's kind of the spectrum on how I see it.
Okay.
Sorry for the tangent.
No, that's really great information. And again, another parallel that I see kind of on the back end with companies and organizations who have traditionally released an annual financial report for shareholders, and more recently, maybe within the last decade or so, have also created and released corporate social responsibility reports or annual sustainability reports. The new push is to really integrate those two things because they're completely related.
Yeah. And if you look at most Fortune 500 companies, they're going to have some sort of corporate social responsibility report. It's almost necessary table stakes in a way now. And part of that is, I think, up to investors or advisors to navigate between that, right? If it's out there because they have to versus a company that truly instills it into all levels of the organization. That is so tough. And it requires a lot of reading and research. And some people at Morningstar, for example, are paid to try to do those things full time, right? But that can be a very tricky thing to actually determine that. Now, on the reporting side, so quarterly earnings reports are something traditionally that analysts in Wall Street will look at, right? What are the financials? What are the earnings this quarter? Very short-sighted typically, but it's still a real thing. You still see it in the news. You see a stock price jump or fall based on quarterly earnings. Financial accounting is done for that reason. It's trying to tell the state of the business at that point in time, right? Where have they gone over that last quarter? Where have they gone over that last year? There's lots of accountants. There's an entire industry around that, reporting the financials of a business. What isn't necessarily required is the reporting of some of these sustainability metrics. Now, a lot of companies are voluntarily bringing that up through their corporate social responsibility reports, but they don't necessarily have to. And I think the push is to get it where it's more of a mandatory, integrated right alongside the financial accounting. So there's a group called the Financial Accounting Standards Board on one side, which kind of governs what is reported on the financial accounting metrics. And then there's the Sustainable Accounting Standards Board, which is an organization that I believe is nonprofit, probably is. We'll fact check that afterwards, but they're probably a nonprofit. And their push is to force companies, force sounds strong, but to require companies to report sustainable metrics that are material to that organization. And we may see an integration at some point in time. If I had a crystal ball, I would hope we see that at some point or more overlap at least, but I don't know where that goes.
We'll wait and find out.
Yes,
there are a lot of moving parts here.
There are a lot of moving parts, but yeah, two sides. I mean, it's merging more and more, right? Because we're finding that yes, these sustainability metrics matter. It's how you're paying your men and your women for equal jobs, right? It's diversity on the board. It's all these different things outside of just typically environmental is the one that gets a lot of the attention, but there's a lot of social things too. Think Nike and the sweatshops, several years ago, right? That was a huge thing when it comes to the responsibility of Nike.
Yeah. And new indicators popping up all the time.
Oh yeah.
As the way we acknowledge issues in the world and figure out the appropriate metrics. So we'll see new indicators pop up, I'm sure.
Well, even just before this, we briefly talked on California pension system. So CalPERS is the pension retirement system for the state of California, and they're historically progressive on divesting, meaning no longer investing in certain organizations. So they've even put divestment screens of linking, if there's any organization linked to Sudan, for example, they divest from that, right? In 2000, I think it was, they divested from tobacco. And so there's, all these different things, but like the Sudan thing is, I don't know if people would think of that right off the top of their heads when they think of ESG or, sustainable investing.
Mm-hmm.
So yeah, there's a lot. There's a lot of variables.
We could talk for hours.
Yeah.
Forward Sustainably is created in partnership with the University of Wisconsin Extended Campus and the University of Wisconsin Sustainable Management degree programs. Find us online at sustain.wisconsin.edu. Why don't we pivot a little bit into the BlackRock discussion?
Yeah.
Can you tell us a little bit about who BlackRock is? Mm-hmm. Tell us a little bit about their CEO and his letter that he sent out.
Yeah. So he sends a letter to the stakeholders every year. And for, I don't know the exact time on this, but it's got to be a decade now that he's been a huge proponent of, hey, CEOs, investors, stakeholders to all these companies, we have to take ESG seriously. And I'll back up a little bit more. BlackRock they're a money management firm, so they have funds. So for some of you listeners, you very well could own BlackRock iShares, for example, that are some funds that BlackRock runs. So it's a way that you can invest through BlackRock. So yes, their CEO comes out with this letter letter to the stakeholders. It's been a decade long that he's mentioning ESG. This is important. And there's more and more evidence that says ESG, it's not just a nice to have. It actually also shows that there can be outperformance in a time of a bull run in a strong market. But arguably more importantly, when there's market corrections, so when the market's going down, it shows that these ESG factors protect on the downside. And that's one of the more significant arguments, I'd say, than outperformance on the upside is protection on the downside. And it's because these companies are incorporating, I use this word to death on this podcast, but sustainable practices into the organization, meaning they're a little bit more recession-proof in most cases.
Resilient.
There you go. That's the perfect word. Mm-hmm. More resilient. So that's something that we're seeing. And for you listeners out there, you can Google this letter to the stakeholders. It's public information. It's just not to the people that are maybe invested in a BlackRock fund. Anybody can see this. So it'd be kind of cool to just check it out and do a quick Google search to see what is included in those letters.
Yeah, I remember when that letter came out. I know he does have his annual letter. Mm-hmm. But there was one maybe like 4 or 5 years ago that was pretty significant, that put a lot of weight on the ESG factors. So it's interesting to watch very influential management firms such as BlackRock kind of send new ripples through the industry.
Yeah. And don't quote me on this. This might be another fact check for the fact checkers, but I believe that BlackRock isn't even a huge supporter on the weight of a quarterly earnings call, right? And they're Wall Street pretty much, right? Mm-hmm. they're a large investor, and the quarterly earnings call, I think, in my opinion, is something that there's just far too much weight. It's too short-sighted. There's too much knee-jerk reaction, and it just influences bad behavior for short-term gain.
So we talked a little bit about the resiliency that funds with stronger ESG scores may have. Has this terminology and way of looking at funds been around long enough in that a financial advisor such as yourself could give solid ROI, return on investment numbers, or quantitative data on whether or not a certain fund or approach to investment is safer?
Yeah, I think my go-to there's a Harvard study that looked at it, and it wasn't necessarily fund specific, but in general, taking a look at the funds that are incorporating those types of factors did in fact appear more resilient, to use that word, more resilient on the downside. Now, if you want to do a fund by fund comparison, that is where I'll say it's an it depends answer, because each fund is different. And with the inflows, we talked about the huge inflows, right? The trillions with the T amount of dollars going into these funds. With that's been happening over the last decade. And with that trend, we're also seeing some existing funds actually add ESG criteria. So it's like, okay, they might have been kind of a traditional fund beforehand, but then maybe in the last year or 2 or 3, all of a sudden they attach the ESG criteria and factors into their investment process. So that gets a little iffy because all of a sudden you're comparing apples and oranges. So if you take that fund and you look at their 10-year track record, let's say 7 of those years is with the traditional approach, and then the most recent 3 is with ESG factors. So that can muddy the waters for sure. The other thing is sometimes there's brand new funds. So there might be a gender or like a women equality type of fund. I've seen them. There's a ticker out there, and this by no means is a recommendation to buy a specific fund, but it's SHE, S-H-E. And that's one that's out there that is a very specific thematic approach. And that might not have the track record. It might not have a 10-year number. So therefore, it doesn't have data from 2008 when that's the true test of resilience in recent memory, right? How did it react in 2008? So that we might not know because the fund literally wasn't around at that time. So we don't know how it would react in the down environment. So when I look at that and you say, hey, how do financial advisors, is there an ROI? Can they show it? What are the numbers? It's going to depend on the portfolio. It's going to depend on what they're invested in, but it's probably most effective to just say, hey, here are some of the criteria. There's studies, Harvard, Morningstar, plenty of white papers that are out there that say, hey, these are more resilient typically in down markets. And we'll see when the next one happens too, right? Because it'll happen at some point in time. We'll see some sort of market correction. Mm-hmm. We don't know when, but it'll happen.
Mm-hmm. And we'll be ready.
Yeah.
If you were to give some advice to, let's say, 2 different demographics, somebody who's preparing for retirement and here's this term ESG, impact investing, and then somebody who's just starting off in their career and they really want to build their portfolio based on their values, what pieces of advice or how can people get started at those 2 different points in their lives?
Yeah, so the ones that might be closer to retirement or even in retirement, I have an example that I'm thinking of in the back of my head where it was a husband-wife combo, and typically they've never cared or maybe even known about ESG investing, I'll say. But it's something I bring up. I like to bring it up in all my conversations just to, again, when we kicked off, educate, right? Know that it's out there, know that you can have a choice. And I've had examples where the husband says, nope, I am not interested in that. And I just want returns and something that'll, make me not run out of money in my lifetime, right? Okay, so that's one. And then the wife might be open to this and she says, yeah, let's actually do it. And we talk about, hey, it could be more resilient in downturns and things like that. And it actually is interesting because I've seen the couple then turn to each other and be like, let's see who does better during that time. So the husband says, I'm going to keep my traditional portfolio. The wife says, no, let's incorporate some of these factors into my portfolio and let's check it out. Now, granted, there's so many other factors too, as far as the mix of stocks versus bonds and types of, so it may not be completely apples to apples, and we make sure we educate that around that. And if they have different risk tolerances, if you've ever heard of a financial advisor, you've probably heard risk tolerance come up in their speak. So all else considered though, it is fun to see that, because it's like, hey, let's try this out. And in that case that I'm giving, I don't know if it was truly values driven, but it's something that I think people are open in that case to at least see what it's like. It's also an additional way to potentially diversify. There's a diversification play there on different funds, different factors. There might be different companies that you're investing in by doing that. Okay, so that's on pre-retiree or retiree side, let's say. And then the other part was questions for people that are younger, maybe, I don't know if it's millennials specifically, but younger, starting investing. Is that
just getting into it? They don't really know where to start, but they're taking a whole different approach to their portfolios.
Yeah. So a lot of times in the people that are accumulating their wealth and they just need to save, and then invest in their retirement account or whatever it might be, it's more and more common that they bring it up before I bring it up even. So they say, hey, I want this in my portfolio. I want some sort of sustainable or impact or, responsible approach to my investment strategy. So I'll say that right off the bat. A lot of times it comes up a little bit more naturally in conversation with younger people that are accumulating. My advice would be, if they're truly just starting, is make sure that you're still getting some sort of diversification. Now, I get the people that want the side pot where they just want to invest in Tesla, right? I want in on Tesla and I'm going to put, 10% of my net worth into it. And okay, you can do that, right? Depending on how risky you are, but make sure you have a bucket that's diversified as well. And in the diversified side of things, just make sure that there's going to be a good mix of your options. So with that, meaning there's lots of low-cost index funds that are out there. There's lots of different providers. I mean, you may have heard of Calbert's or Domini or Nuveen has a great ESG suite, BlackRock, iShares, right? There's plenty of options out there. Make sure it's diversified. Make sure it's lower cost, right? And that's a way to start. And if you see that ESG on there, you can filter. You can go to Morningstar, literally press an ESG filter, and it'll scrub away the, I'll say that the bad funds, so to speak.
The room for opportunity funds.
Yes, that's actually a very interesting point because they measure trends too.
Oh, wow. Okay.
Right? So
Neat.
there are funds that might be trending in the direction of, hey, they're adding more organizations that we don't consider sustainable, versus the other side is, hey, we're trending that they're adding different organizations or even on the organizational level. For example, there are ESG funds that have added Shell, I believe it is, because if they look at their numbers and their investment, they're saying, well, they are putting $6 billion into renewable energy. That's significant. And depending on where your bar is and where your criteria is, if you're looking at them as an energy company and they're investing in renewable energy in that way, there are some funds that would include that actually. So that's an interesting one too, where they're saying, well, they were out, big oil and gas, but actually, where they're going in the future, they might actually get into an ESG fund in some cases, not all.
Mm-hmm.
So
that's great.
Yeah.
Yeah. I mean, my assumption would be that we're going to be seeing more those trends or those companies kind of flipping.
Yes.
So in the positive direction.
Right.
And, on the last episode, Tom and I talked about near the end, kind of the power of individual action to create change in the world. And I'm a really big believer in that. And so it's interesting to think about consumers, investors, not only putting their money where their values are, but also that incredible driver to create change within Fortune 500 companies, because these companies are going to have to have some sort of baseline and show improvement. So that's just a really powerful way to look at this from an investment standpoint.
And it's interesting because the easiest thing as a consumer is to buy the products that you support. And a lot of times on the environmental side, people think of Patagonia, right? So they will have their Patagonia gear, and that's easy. I can go online, I can buy it at the store, I can procure that relatively easy. It aligns with my values. Awesome, right? They're a private company. A lot of times people don't think of, well, what is happening in the 401k side? Those are all the Fortune 500 companies, and that's a huge area for growth and improvement, an improvement area, because 401ks typically just still in 2019 don't have as many sustainable or ESG options as you think there would be. Now we're seeing a little bit more of it, but even then there might be one fund. It's like, oh, here's a clean energy fund. or here's, one or two. And it's even tough to get diversification in some cases in your 401k if you're looking for some sustainable options. So that's, like I said, easy to go buy your Patagonia or whatever product it is. A little bit tougher to put your investments in your money for long-term retirement or savings, in a way that aligns as well.
Definitely. And this morning on Business Insider, once this podcast airs, I'm not sure if the Amazon will still be burning, but as of this morning, it is, very sadly. And there's a headline from Business Insider that says the company that owns Timberland, Vans, and the North Face has decided to stop buying Brazilian leather in response to slow action by Brazil to battle the fires, essentially. And so I'm not sure, if there was a key consumer driver behind that, or if those companies are just very aware of the bad PR that comes with their supply chain impacts and things like that. But again, the parallels behind business decisions, responding to things that are happening in the world, and consumer and investor choices.
I think it's all the above. Some of it's just PR. Some of it is, if there's shareholder resolutions that are filed to address a certain area of an organization, I think it can be a combination of a lot of those things.
Definitely. So as we begin to wrap up here, what do you see happening in the industry right now that is super innovative?
Super innovative. Well, I think that I'm going to go back to things that we've actually already talked about. And some people might laugh because they might not think it's innovative, but I still think the concept of SASB, which is the Sustainable Accounting Standards Board, I still think that is innovative and new. Most people don't think of reporting sustainability factors as something that is pertinent to the materiality of an organization and the financial ramifications for that, for the common investor, I'll say. So that's something that if there is some sort of merge or integration between FASB and SASB, again, FASB is the financial side, SASB is the sustainable, environmental, social side. If there's some sort of integration there in the future, I think that would change just so much. So, it's not brand new. SASB's been around for a while, but at the same time, it still seems innovative to me because I mentioned it before, $1 in $4 of invested dollars is going towards ESG funds. So that obviously flipped around, 3 or 4 is not. So I think the more those things integrate, the more we'll see investor behavior and then therefore company and organizational behavior change.
Totally agree. It is innovative. You bring up SASB and people don't,
It's not a common thing.
It's not a common thing.
No. It doesn't pop up during the water cooler conversations, I don't think.
Right. But. We'll start. I'll start bringing up SASB.
Yeah.
So as we wind down, what is one tool or piece of wisdom or resource that you'd like to offer our listeners today?
Sure. Check out Morningstar. There's paid subscription access, of course, but a lot of times you can go to your library, like use your library card. I know in Madison you can use your library card and log into Morningstar, and the city of Madison has a subscription essentially. So there's tools there. A lot of it can be, if you're not financially savvy, it can be numbers and ratios and things that mean nothing and you might gloss over. But if you can find your way into the sustainability side and see how are some of these funds, you can just pick one from your 401k, pick one from your Roth IRA or your brokerage account. Check it out. Am I a 1 globe fund or am I in a 5 globe fund? Like, where am I even at? So just try to figure out, where are you currently? Where am I at? Is there room for improvement? And I think Morningstar is a reasonable place to start to do that for a common investor. And then also know too that if you have individual funds, they'll send out these prospectus, which tells you the exact objective of the fund. And if you look in that investment objective, it very clearly might state the objective of this fund is capital appreciation. Then you know that growth is important. It's probably favored in stocks. And it also might be financially driven over an investment objective that says, hey, the investment objective of Fund B is it might still be capital appreciation with respect to environmental, social, and corporate governance factors. That could be a very different looking fund than Fund A, which is only seeking capital appreciation. So understand what you own. For starters, there are resources. Use a Morningstar, use an advisor, use the prospectus, which is you're not going to just sit down and read a prospectus cover to cover, unless you're in an investments or portfolios class, or, for you badgers out there that are studying, maybe you do want to read the entire thing, but usually that's up for the professionals to do.
Thank you so much. I have a lot of homework myself to dive into here, a lot to learn, and it's constantly changing. So we really appreciate you joining us today on the podcast. It was really fun to talk to you.
Yeah, thanks for having me.
Thank you. Thanks for spending some time with us today on the Forward Sustainably podcast. Today's episode is supported by our campus partners in the University of Wisconsin system, including Parkside, Oshkosh, Green Bay, Superior, River Falls, and Stout. If you found today's topic interesting, feel free to rate and subscribe wherever you find your favorite podcasts. If you have comments, questions, or recommendations for future shows, contact us at forwardsustainably@uwex.edu and make sure to find us online at sustain.wisconsin.edu.